Hello everyone and welcome to our channel Claim What's Yours. Today I'd like to talk to you about credit shortfall, finance shortfall, and how it affects you as the insured and the owner of the vehicle and your credit agreement with your finance company. So recently we had a client, owned a vehicle, his vehicle was involved in a total loss, and he inquired from us, well, what cover do I have under my short-term insurance policy to cover my vehicle and to cover the amount of money that I owe the bank, the resultant amount that I owe the bank. So in terms of your short-term insurance policy, your policy pays for the retail value of your vehicle as at the date of loss. So in the example that I'm going to share with you online, we've taken a vehicle date of purchase, 200,000 Rand, trying to keep the numbers simple so we can all follow the maths and the calculation. And you went to the bank, you applied for finance, and the bank said to you, yes, in terms of the interest rates that you have or that we have, we are now going to charge you 100,000 Rand interest. So, in fact, you now owe the bank 300,000 Rand for a 200,000 Rand vehicle. In terms of the lease repayments, there are 60 lease repayments, equal numbers of 5,000 Rand a month, as I said, to keep the calculation simple. So the example we're going to cite you is that after 13 months, of your 5-year lease, your vehicle is involved in a total loss, so whether it's stolen or hijacked, and you're unable to use it anymore. So your insurer says, yes, you complied with all of our conditions, and we're going to pay your claim. So the insurance company says, right, cool. Here's the payment, less the excess. Because there is a hire purchase or lease agreement in place, all that money goes to the bank. Bank gets first dibs at the bucks. So now you say, okay, that's cool, thank you. I don't have a car, and now I owe the bank. Do I still owe the bank any money? The bank says, yes, of course you do. So in terms of your lease repayment, the vehicle's worth, the vehicle from the bank's point of view and the outstanding finance agreement is a separate issue to your insurance policy. So your insurance policy 13 months in said 150,000 Rand is the retail value as at the date of loss, less the excess on the policy, that gives the settlement of 145,000 Rand. Let me just check my numbers, that's right. Yes, 145,000 Rand. In a linear calculation, money that you owe the bank, so after 13 months, you owed them, beginning 300K, now you owe them 235,000 Rand, so there is a 90,000 Rand shortfall. So the bank says, look, we're not involved in that. Did you buy finance shortfall cover? If you purchased finance shortfall cover, that additional amount that's due to the bank can either be paid by your insurance company. So if you purchase finance shortfall cover, you would need to notify your insurer of the finance company's name. You need to provide them with a copy of the finance agreement, and they would then note that onto your policy to say that, yes, we've got the vehicle insured, and in the event of a claim, we're going to pay the bank. All of that money, for the intents and purposes of this conversation, all of the money that would be paid by the short-term insurance policy, in this example, would be paid to the bank as there is outstanding monies due to them. So your policy would pay the own damage section of the policy as a claim, and then they would pay as a separate section credit shortfall, and both of those monies would be paid to the bank. What does it cost you to buy this type of cover? When you buy the cover, so say, for example, the insurance company rated you're a good risk, and they were charging you a rate of 4% on the value of the vehicle. So it's what, 8,000, 2 4s, 8 grand, it's 700 Rand a month. The same would apply to the credit shortfall amount. So the extra 100,000 Rand, they would charge you and say, we're going to charge you 4% on that, so we're going to charge you an extra 4 grand. Your total insurance bill for the own damage and for the credit shortfall would be another 4 grand, 8 and 4 is 12, it's 1,000 Rand a month. That's what it would cost you. So the rate on your motor vehicle is generally the same rate that the insurer would charge you on the credit shortfall for your vehicle. Are there different options available? Yes. So when you take out finance from the bank would like to offer you credit shortfall as well. And in terms of the Phase Act, they would get a representative, an insurance qualified representative, to run through those finance arrangements with you, because they are all short-term insurance policies and are governed by the Phase Act. So they will run through the various examples with you. So just to go back a bit, your short-term insurance policy that you have offered by one of the leading insurers offers you credit shortfall cover only. The bank would offer you a whole lot of value-added products, so they can include extras like we can provide money for the deposit you paid. So if you put a 50,000 Rand deposit down on the vehicle, you buy a cover that if your vehicle is involved in a write-off, they will pay you back your full deposit. They will also pay you your excess, so you can buy another value-added product to cover the excess. They will then also add cover, so if you're retrenched from work or you've lost your job, they will also say to you, yes, we will pay you some money for 6 months to allow you to continue to pay your lease repayment, that you don't fall behind. So the cover offered by the finance companies, the leading banks, is more comprehensive than those offered by the short-term insurer, as one section is credit shortfall, but there obviously are cost implications. So we encourage you to have a look at your insurance policy and to make sure that you have the option to buy this cover, that you're aware that the cover exists, that you do not end up short when your motor vehicle claim, own damage claim, is settled by your insurer, and that you haven't taken into account that you may owe money to a finance corporation for your vehicle. So the example I've cited, which I'm going to share on the podcast with you, is a vehicle that is financed over 5 years, and an accident happened 13 months into the contract. Let's take an example where you have a 5-year finance contract and the claim happened